over what we typically term as the smart money levels. Now, we've had a lot of questions on it. The basis for what we do revolves around the fact that banks have no choice but to accumulate a position, manipulate the market, which is often marking the end of the accumulation because it in and of itself is a form of accumulation. They're inducing one side of the market so they can either buy into selling pressure or sell into buying pressure. Again, they need the opposite side of the market, therefore they create the belief in the opposite side, and as they're creating selling pressure, they're buying into it, or as they're creating buying pressure, they're selling into it. So when we think about the very basics of that, if they've accumulated a position, they manipulate the market, they enter then a trending phase in the market. Well, one question that we have is how do they trend the market? What can we use to catch this weekly trend that how they often drive the price through the course of a week? Generally, don't tend to drive the price over the course of the entire week, but it's a good chunk of the week. Usually 3 or 4 days, they tend to drive the price, but we can capitalize on that once we've seen seen the first push. And so what I want to cover here is just going back over some things that we were looking at in the room, things we posted in the forum, trades we were taking, and it's going to be a three-part series on, more than likely three parts on essentially breaking down what they're doing. So when we're looking at the euros, this is back in March 21st, we were sitting in this accumulating type price action. They're hitting the lows, hitting the highs, hitting the lows, hitting the highs, confusing traders. Typical price action right before the market moves. It's not coincidence that you see this type of back and forth, hit the highs, hit the lows type price action before the market moves. Now the market tends to move once it starts that trend. They tend to move the price in three waves. And so after we've seen that accumulation, after we've seen the first push up, we know that the probability lies in two more to the upside. Now again, this is a probability. This is gives us a strong indication of where we should look for manipulation at. One trade specifically that we were looking at in the forum on this one thing that we were screaming about for a day or so on the euro was at the end of this third push. Not only is there that weekly cycle that tends to happen over the course of 3 to 4 days, but there's also that intraday cycle that tends to happen as well. And while the intraday cycle can get a bit muddy and can be not quite as clear, when it is clear, that's where we're really able to capitalize on it. So let's zoom in here, and again, this looks like the third push is completing on this day, and we were actually in the room at this time. Going to the 15-minute here, I'm going to zoom over, and if you notice on this day, again, let me zoom out a little bit. We went into everything that happens on a longer time scale happens on that shorter time frame scale as well. So we fell into accumulation again. They accumulate before they move the price. They manipulate the price down, inducing selling, buying into that selling pressure, and then we see the first push up. We see a second push up, and we see that third and final push up. In addition to that third and final push up, what do we have? Well, at the end of that move, we also have a stop run. So we're getting a lot of indication here. We're on the third day in the weekly cycle. We've had three short-term levels to the upside, and the market's ending with a stop run. If you're not familiar with the stop run, there's a video a couple years back I did that's on YouTube of the stop run reversal. And when we see all that really coming together, that's what's giving us an indication of, hey, this market has an extremely high probability of reversing. That's why, again, I was mentioning this in the forum, mentioning in the room, and it gave a great opportunity. I believe the Swissy was setting up exactly inverse at this point for a nice trade as well. So as we go out, we move forward. What do we have coming back the other way? Well, we have our first push down. Accumulation, second push down, more accumulation, third push down. So another great trade we had at the end of in the third push. Unfortunately, we were actually in the second push. It just stalled for a little bit longer. Some of the members did very well, and I personally was not in that second move down, but did very well on this third push. Now what happens? Again, third push in the overall weekly cycle that tends to happen over 3-4 days, sometimes 5 days, as was the case with this one. It just drags on for a bit longer. But actually, I think this was closer to 4 days. But at the end of that move, what do we see? Well, same thing as you always generally tend to see, or a common thing you'll tend to see, is you'll see a stop run. You see it blow through the lows at the end of the third push. And as it's blowing through those lows, again, what are they doing? If they were short, they have to buy their position back to close out that position for a profit. How do they buy the position back? Well, they have to induce sellers, correct? So if they drive the price beyond that low, what's happening? They're inducing breakout traders, and anybody that was long expecting this low to hold is getting stopped out. Therefore, they have to sell it back. So you have those that are selling on the breakout and those that are selling as they get stopped out. Smart money buys into that selling pressure, and that's why you see the stop run at the end of the move. They're using that to close out their position for a profit. So what we did here, this is a trade again. We mentioned in the forum, mentioned in the room. Couple traders got it. Very nice trade on this one, and we actually closed this one out in the room the next day for 125 or so pips. Not every trade's gonna run that far, but that was just happened to be a nice example, giving us a good example of what we're looking for. Now again, this was we had what looked like the first push down. It looked like we were going to continue. We went through the previous low, so it looked like we were going to make it looked like this was the first push down, and so we were expecting two more to the downside. Now again, using the intraday cycle of tends to drive the market in three waves. When we came out of this low, we made a first push up, we made a second push up, we made a third push up. This is again something we mentioned in the forum. We had three cycles against the overall cycle. It gave us another great shorting opportunity from that point. Go back out to the hourly, and we will again that completed with a second push down on the third day. Ended up making that third push to the downside. And what does it end in? Well, again, another stop run. They drive the price past the low, quickly reject it back up. Now, these aren't huge stop runs. You're not seeing it blow through by 10, 15, or not by 20, 30 pips. You're seeing it blow through by 5, 10 pips. Nonetheless, illustrating the point of that stop run coming at the completion of the third push down. Now, again, what do we have here? Well, we had the first push up. Now, what was interesting about this one, actually, I posted the review a member review. It's on the site from this day where we were calling the entry or exactly what was going to happen out of Asia, 12, 14 hours in advance. And that's you're not going to have the opportunity to do that every time. But when the first push is clear, you're more than likely going to see two more in that same direction. So we said, okay, let Asia accumulate, look for the manipulation out of Asia. We got that manipulation down. People did very well at second push up. Same thing the next day. Accumulation during Asia, manipulation down, third push up. Same thing's going to happen because that's how smart money drives the price. While it's not going to be perfectly clear all the time, there's enough time to where, as I said in the room, how many times does it take of catching that move before it makes a great month or a great week? And it doesn't take too many of those to equal a nice week. So how do you determine levels? How do you determine, okay, well, was that a true first push or was that a true second push? It's all about context. It's all about the context of what you've seen prior to that. You got to figure, when we see three levels down, we're expecting the market to reverse until proven otherwise. And so we saw three levels down. We saw it ending in a stop run, and then we saw a strong first push up. So that gives us a good indication that, this truly is reversing. Now, additionally, another rule we use is that the market, if smart money is truly driving the price, is not going to be a 20, 30 pip move. And that's where we get our risk reward from. If we've correctly identified what smart money is doing, it's not a 20 or 30 pip move. And so a base rule to use is what we call a 90 pip tool. And again, it's a tool because it's not a rule, it's a tool. It's an indication of how far we should at least expect the market to go if smart money is truly driving it. Now, this tool will fluctuate as time goes on. If you were using 90 pips 5 years ago, you would have been in trouble on the pound. You've been missing a lot of the move because, 4 years ago or so on the pound yen, it was very common to see 300 pip nights, 1200 pip weeks. You go back and look at these charts, and so this rule is going to change as the volatility changes over the course of months and years. You're either going to have to be shrinking that or increasing that. And again, it's not rocket science there. It's just a general rule of thumb. How far they're going to tend to drive the price. 90, 100, 110 pips tends to be the common denominator. Now, we just choose the low side, so we play it safe. So again, you look at these moves here, and are they fulfilling 90 pips? Well, first move up, 115, fulfills that criteria. Second move up, 138. Third move up, 122. Now we go back and we look at the same thing. Again, the same thing on the way down here. We were measuring it from this point, 150. Obviously, from the highs, it was a bit more than that. But we were measuring it from there because, again, we were Really wasn't a clear first push down until that point. Second push down, 140. Third push down, what do we see? Well, 120. So again, we go back to this, and these, I can tell you right now, these levels were well over 90 pips each. But that's what's given us a good indication of, was that truly the first push, or was that truly the second push? Well, did it meet 90 pips? And that was another indication that was telling me, when we were taking the short from here, that was another indication that was telling me that this overall weekly third push was over. We had moved 127 pips at that point. What was the second move? Well, 109 pips. What was the first move? 113 pips. So again, we're taking the low side of how far they're going to tend to move the price. And if it's not fulfilling that criteria, if it's 70 pips, well, maybe we need to sit back and we need to reassess. So the key here, guys, is looking for the three cycles, and again looking for the reversal at the end of that third overall cycle, because that's where people get into trouble. They say, okay, well, I got a trend now, and that's exactly the point when they tend to reverse the price. That's why you hear people say the trend's your friend. Well, I don't know a single trend follower that does extremely well on a daily or on a short-term chart. I believe that on a longer-term chart somebody could do better with it, but on a short-term basis, I don't know a single trend follower that. And again, I'm always happy to be proven wrong, but anytime I say this in the room, where somebody is just blindly following a trend, it doesn't tend to work out, because that's not how smart money drives the price. They assess the market, where's the money at, they drive it for 3 or 4 days, and then they reassess where the market's at, where's the money at, because it's not where the fundamentals are, it's not where the technicals are. It's a very simple thing. This is their market to make money in. This is their business. And so the simple question becomes, which way should I drive the market to accumulate the largest position and create the largest profit on this move? If it's to the downside and that's against fundamentals, well, that's where it's going. If it's to the upside and that's against fundamentals, well, that's where it's going. So look for this cycle, guys. Again, these moves tend to be at least 90 pips. They tend to be separated over the course of 3 or 4 days. They tend to start out of Asian accumulation. And you start putting these tools together, when you see the end of that third push, you're going to say to yourself, okay, well, it's the end of the third push. I'm seeing a stop run at the end of this move. Maybe I should be looking for a move the other way. Just a few tips to again get into picking those out a bit better. Now I'm going to pick on somebody from the room here real quick. We'll go over to the euro. And last night looked like we had a first push out of accumulation in the euro on the hourly chart starting on the third. It looks like we had the second push down, and one of the members in the room, I'll leave him unnamed, but actually no, I'll call him out. Daniel, he was posted in the room, and I felt a bit ashamed, because Daniel's actually absolutely cleaned up on me in the last 2 months. He's outperformed me, but on this one move, he was taking the euro dollar, the euro yen, and the pound yen with a closed position. I'll post the screenshot I took out of the room. He'll probably yell at me for that, but I took a screenshot of the room of him posting his pip count for that move. And this is a trade not just he caught. Other members in the room are doing very well with it, because again, they're looking for those levels. They're saying, okay, well, I've seen 2 to the downside. I'm expecting that third push, and again, they're doing very well with that, eliminating a lot of the factor of direction. Direction is a huge part of it. There's direction and there's timing. If you can eliminate direction, it simply becomes a matter of timing. And timing is what we're going to get into in the next videos, because we can time when these have a high probability of starting with the second push or the third push. With a very strong high probability, we can select when they're going to drive it, and then exactly time that out with some other tools that we use. And that's what we're going to get into with the other parts in this what is probably going to be a 3-part series. So it really comes back, guys, to the basic principle I like to use, and that is, we'll never know everything that the banks are doing. We know certain things with a very high probability, but we'll never know everything. And it's similar to that of a puzzle. If there was a puzzle of say your spouse, or whoever it may be that's familiar to you, how much of that puzzle would you have to have complete before you recognize the picture in that puzzle? Well, if it was somebody very familiar to you, or a picture of your house, and that was what the puzzle was, as you got 50 or 60, or maybe even, maybe it takes you 70% of the puzzle to get done before you recognize it, you would recognize what that picture was. And it's the same thing with what we do. The banks leave a trail because they have no choice but to leave a trail. Because of the position size they enter, they have to induce sellers to do the opposite of what they're, or traders to do the opposite of what they're doing. If they want to buy, they have to induce selling. If they want to sell, they have to induce buying. It's a basic market fact of supply and demand. So because of this, they leave essentially a footprint in the sand, and that's what we're tracking. They tend to drive the price a certain way. And again, while we never know everything, we know enough to really capitalize on it when things become more clear. And that's exactly, that's really not much different than uh, what Daniel was saying in the room. And I think he brought up a good point. And we're Chad and I are very appreciative of members that give back because they feel like they've got to the point where they can give back. And Chad and I are very appreciative of it because it helps traders. It's a different insight. They point out what they do, and it's a different insight. And what he was saying was essentially a principle that we hold very close to what we do. Hey, there's going to be times where we sit on our hands and we do nothing. Maybe we do nothing for a couple days. But when the time comes when it's very clear, as it always tends to happen on a, generally happening at least once a day, um, but even if it's a couple times a week, when it's very clear, you're really able to take quite a few pairs as he did last night, and take what would generally people would be happy for or happy with in a month, take it in a night. And while again, Daniel's been quite the superhuman lately, the point is a lot of members are catching it because they're being patient, they're staying disciplined, and they're waiting for the proper setups, which Chad and I couldn't be happier with. So all right, guys. Well, next video we're going to get into timing a little bit more. Again, look for these levels. If you've seen a first push out of accumulation, you're probably going to see two more in that direction. Did the move go 90 pips? Is the move separated by clearly separated by some type of accumulation? That's what you're going to be looking for. Is it coming off of a stop run? Did you see a stop run and then you had a first push? If that's the case, well, even more of a likelihood of seeing two more in that direction. So I hope this video helps guys more, and I will see you guys then. Happy trading.